Welcome back to the deep dive. We're here to take those dense financial documents and, well, make them make sense for you.
Exactly.
Today, we're tackling PepsiCo. Specifically, their Q3 2025 earnings release. It's quite the document.
Oh, it really is. And honestly, this is the perfect candidate for a deep dive because those top-line numbers, they can really throw you off if you're not careful.
Right.
So our mission today is pretty clear. Cut through that complexity. We need to separate the official reported figures, that's the GAAP stuff, from what the company sees as its core performance, the adjusted numbers.
Because that difference tells the real story.
It really does. For you, the learner, getting this distinction down, that's absolutely key to figuring out how healthy the actual business is underneath all the accounting.
Okay, so let's talk about those scary headlines first, because if you just glanced at the GAAP numbers, yeah, you might hit the panic button.
You really might.
Is this some kind of, fundamental collapse, or just the usual accounting adjustments making things look worse?
Well, let's lay them out. Top line first. Reported net revenue for Q3 2025 was up 2.6%.
Okay, not terrible for Q3?
Not terrible, but look year to date, only 0.8%.
And then
The big one, earnings per share. Year to date reported EPS, $4.15. That sounds okay until you see the change from last year.
which was?
A negative 29% change.
Wow, okay, minus 29%. That's the kind of number that definitely grabs attention.
That tanks stock prices, usually. But like we said, that number isn't the whole picture. It's got noise in it.
So how much better does it look when we strip out that noise, when we look at the core performance?
Dramatically better. This is where you find the operational truth, really, in those non-GAAP measures.
So what are those numbers?
Organic revenue that's non-GAAP was up 1.3% for the quarter and 1.5% year-to-date, much smoother.
And the core EPS, that must be way different from minus 29%.
Way different. Year-to-date core EPS clocked in at $5.88.
Okay, $5.88 versus $4.15 reported. That's a big gap. But the change year over year is the key thing here, from minus 29% reported.
Right, that massive drop.
To what on a core basis?
Well, they talk about core constant currency EPS change. We need to break that down. But the bottom line is that figure only declined 3.5% year-to-date.
Okay, hold on. From a 29% decline reported to just a 3.5% decline on this core constant currency baseline.
Exactly. That is a phenomenal swing.
So if the underlying operations are, relatively stable, like that 3.5% suggests, what on earth is causing that massive 25+ percentage point drag on the official GAAP result?
Okay, so this gap comes down to those two key adjustments that get you to core constant currency.
Right. Core and constant currency.
First, the core bit. This takes out the big sort of unusual or one-off items. Think major restructuring costs, maybe a big legal settlement, or like we'll see here, huge asset write-downs, stuff not related to selling chips and soda day to day.
Got it. One-time noise.
And second, constant currency. PepsiCo is global, right? So when they bring earnings back from Europe or Latin America, the exchange rate matters.
Fluctuations in the euro or the peso versus the dollar.
Exactly. Those swings can make reported earnings jump up or down, but it has zero to do with whether they actually sold more Doritos in Mexico. Constant currency strips out that FX volatility.
So core constant currency is basically management saying, look, ignore the currency markets messing things up and ignore these specific big cleanup costs we had this year. Here's how the actual business performed.
You've got it. And that number, the core constant currency EPS change, only down 3.5% year-to-date, that tells you the engine is running relatively okay. But yeah, they had some very expensive messes to clean up on the accounting side this year.
Okay, but management can't just ignore that minus 29% gap figure either. What's the narrative from the top? How is CEO Ramon Laguarta positioning this? What are the plans going forward?
Laguarta's message was definitely focused on resilience and acceleration. He pointed to that improved reported net revenue growth in Q3, highlighting strength overseas the international business and better momentum in North America beverages, PBNA.
Okay, so acknowledging the situation but pointing to positives.
And laying out the strategy, it's sort of twofold. One, accelerate growth where they can. And two, get really aggressive on optimizing costs.
The classic playbook. Grow the top, protect the bottom. What are the levers they're pulling?
The usual suspects, really. Strong innovation pipeline new products, sharpening their pricing strategy, they call it price pack architecture, which means finding the right price points and package sizes.
Right, getting the value equation correct for the consumer.
Exactly. And then the cost side. Right-sizing the entire cost base. That means efficiency drives, maybe restructuring, classic CPG management stuff.
But for a company like PepsiCo, the health check always comes down to how they're growing revenue. Is it just price hikes, or are they actually selling more stuff? What did that price versus volume mix look like?
That's crucial. And year to date, that organic revenue growth of 1.5%, it was almost all price.
Really?
Yeah, they managed a pretty strong 4% increase in what they call effective net pricing.
4% price increase across the board, effectively. That's significant pricing power in this environment.
It absolutely is, but, and this is the key point, that 4% pricing gain was offset quite a bit. They saw a 2% decline in organic volume.
So fewer bags of chips, fewer bottles of soda actually went out the door.
Correct. Fewer physical units sold overall. But the higher prices they charged more than made up for it, leading to that 1.5% organic revenue growth.
So it paints a picture of a company really focused on protecting its profit margins, maybe even if it means some consumers buy a little less.
That seems to be the strategy. And quickly, on foreign exchange, that currency volatility we mentioned.
Yeah, was that a big factor?
Not huge, but it was a headwind. The report shows FX dragged down net revenue by about 1 percentage point year to date. So the really big swings we're seeing between reported and core, it's not primarily currency this time, it's those items affecting comparability, those one-offs.
Okay, so let's dive into those segments then, because that's where these adjustments really make a difference, right? Especially on the operating profit line for Q3.
Absolutely. This is where you see the JAP versus core story play out region by region.
Where should we start? Maybe somewhere things looked pretty good. EMEA, Europe, Middle East, Africa.
Yeah. EMEA looks solid. Reported revenue growth was strong, up 9%. Organic growth was also decent at 5.5%.
And the profit, did the adjustments help there too?
They did, but the underlying picture was already good. Core constant currency operating profit still grew by 3%. So that's indicating real operational strength there, not just accounting adjustments masking problems.
Okay, solid performance in EMEA. Now for the tricky ones. North America Beverages, PBNA. You mentioned momentum improving, but the Q3 reported operating profit down 20%. That looks awful.
It does look awful on the surface, but this is a prime example of those adjustments at work. That 20% decline is heavily skewed by charges taken in the quarter.
The items affecting comparability.
Exactly. For PBNA in Q3, those items actually provided a positive 13 percentage point impact when calculating the core change.
So they added back 13 points worth of charges.
Essentially, yes. Once you exclude those one-time costs, the core constant currency operating profit decline shrinks dramatically. It goes from minus 20% reported to a much less scary minus 7%.
Okay, minus 7% is still a decline, but way better than minus 20%. That 13-point difference really shows the scale of whatever cleanup costs PBNA had.
It does, and you see an even more striking example over in LATAM Foods Latin America.
Okay, there.
Reported operating profit was down 12%. Again, looks like trouble.
But I'm guessing the core story is different.
Completely different. Once you apply the adjustments, the core constant currency operating profit actually grew by 9%.
Wow. From minus 12% to plus 9%. That's a 21-point swing.
Let me check the math. Reported down 12, core up 9. Yeah, that's an 18 percentage point impact from comparability items, actually. The difference is huge.
An 18-point swing? What was driving that?
The source material specifically mentions an indirect tax audit settlement in LATAM as one of those big comparability items excluded from the core result. So a large, non-operational payment dragged the gap number down.
Makes sense. Finally, let's look at the other North American giant. PFNA, PepsiCo Foods North America, Frito-Lay, Quaker. Did they manage the price over volume thing better in Q3?
Actually, PFNA is where you saw that tension most clearly in the third quarter. Their organic revenue actually declined by 3%.
Declined, even with price increases.
Yeah, it was driven by a pretty significant 4% drop in organic volume. They did get a 2% gain from effective net pricing, but it wasn't enough to offset the volume loss in Q3 for snacks.
Interesting. So unlike the year-to-date picture for the whole company, Frito-Lay's price hikes in Q3 couldn't quite cover the consumer pullback on volume.
Exactly. And that flowed through to profit. Their core constant currency operating profit was down 3.5% for the quarter, reflecting that, slight operational dip.
This whole analysis really hands on understanding those massive one-time charges.
Yeah.
You mentioned asset impairments earlier. Let's put a name and number on the biggest one driving that huge gap versus core gap year-to-date.
This is really the centerpiece of the Q3 financial story. Year-to-date, PepsiCo recognized, get this, $1.993 billion in impairment of intangible assets.
Almost $2 billion, just written off.
Just about. And compare that to the prior year, it was only $24 million.
Tiny in comparison. So what intangible assets suddenly lost almost $2 billion in value?
The report is very explicit. It states this enormous charge was primarily related to the impairment of the Rockstar brand.
Rockstar Energy. Okay,
Yeah.
that's a huge write-down on that acquisition.
It's a very visible admission that maybe the price they paid, or at least the value they assigned to its future potential back then, was just too high and needed a major reset based on current reality.
So does this mean Rockstar is, like, dead in the water? Or is it just an accounting adjustment?
It's definitely a painful accounting adjustment. They're resetting the value on the books based on updated forecasts for how much cash they think the brand will generate. It doesn't mean they're stopping production tomorrow.
But it explains a huge chunk of that gap hit.
A massive chunk. If you look at the breakdown of the core EPS adjustment year to date, $1.12 per share of the difference between GAAP and core came just from that impairment charge and related items.
$1.12 per share just from that write-down.
Yep. And there was another $1.34 per share difference coming from restructuring and other impairment charges. So these are big, non-operational balance sheet cleanup costs hitting that GAAP result hard.
Okay, so they took their medicine with this huge Rockstar write-down. After all that, what are they telling investors about the rest of 2025? Did they change their outlook?
No, they actually affirmed the key parts of their previous guidance. They still expect organic revenue to grow in the low single digits for the full year.
So steady as she goes on the underlying business growth target.
Right. And they expect core constant currency EPS, that operational measure, to be roughly even with the prior year. So basically flat on the bottom line operationally, despite the Q3 dip.
They're basically saying, yeah, Q3 had this big write-down. Ignore that for operational trends. The engine's performing as we expected for the year.
That's the message. And there was actually a little bit of good news on the foreign exchange front, too.
Oh, yeah. The headwind got smaller.
It did. The expected drag from FX on both reported net revenue and core EPS for the full year is now only expected to be about 0.5 percentage point.
Down from what they thought before.
Down from about 1.5 percentage points previously. So that provides a little bit of unexpected relief to the final reported USD numbers. Not huge, but helpful.
And what about shareholder returns? Still committed to dividends and buybacks?
Very much so. They reiterated their plan for total cash returns of about $8.6 billion this year.
$8.6 billion. How does that break down?
The lion's share, $7.6 billion, is earmarked for dividends, and the remaining $1.0 billion for share repurchases. So still a strong commitment there.
Okay, let's wrap this up. What's the key takeaway for you, the listener, trying to make sense of PepsiCo's performance?
Well, I think this deep dive really highlighted it.
Yeah, those reported GAAP numbers, they looked pretty alarming at first glance.
Yeah.
Especially with that huge minus 29% EPS change year to date.
Right. Catastrophic looking. But driven heavily by massive one-time charges. Specifically, that nearly $2 billion impairment tied mainly to the Rockstar brand value.
But when you look past that, at the core constant currency figures,
The underlying business shows, I'd say, resilience. They're managing targeted growth, especially internationally, and they're using strong pricing power to navigate inflation.
it really underscores why understanding those non-GAAP adjustments, the core figures, the constant currency, is so vital. It's management's view of how the actual operations are doing.
Absolutely essential. But that leads us to the final thought, the provocative question for you to keep tracking.
Okay.
We saw that the business right now is really leaning on price increases, that effective net pricing, to drive overall revenue growth. But we also saw organic volume declining, both year to date and pretty sharply in PFNA during Q3.
So people are buying less stuff but paying more for it.
Exactly. And the question is, how long can that pricing power alone sustain the kind of growth they're targeting, that low single-digit organic revenue growth, if the actual amount of product they sell keeps shrinking?
Right. At some point, you need volume, too.
You do. That pressure point, the need for real innovation that drives actual physical sales, not just relying on price hikes. That's the strategic dynamic you really need to watch in PepsiCo's future reports. How do they get people buying more again? That's the core challenge ahead.